In this episode, we're talking about the questions you should be asking your advisor.
Hello, everyone. Thanks for tuning in here. Wanted to talk a little bit about questions for your advisor. For us as advisors, if you're our clients, and for those who are not our clients, questions that you should be asking your advisor.
Yeah.
We've seen some market volatility recently. We're not necessarily saying that a correction is about to happen. You need to be super, super worried. But if this volatility is making you nervous and it's just something that you're uncomfortable with, we wanted to give you the questions that you should be asking your advisor that should allow you to know whether or not you're with the right advisor or on track.
You're on track to accomplish your goals. And I think what's really important is that we know that some of you watching are our clients already. And, for full, open, and radical transparency, as we call it, we want you to hold us accountable too, which is why we're happy to send you the questions that we're proposing other people should be asking their advisors. And so if we haven't answered these questions for you, give us a shout, and we want you to hold us accountable to them.
So the first question, Grant, what rate of return do I need to achieve my goals? Talk a little bit about this question, why it's important.
Yeah, so this is something that we term the family index rate, which is ultimately derived from your financial plan. What we do is very simply, we take all of your financial objectives, all of your objectives in general, and we determine what rate of return you need to accomplish to meet those goals. And that's the rate of return, the number one rate of return you should be focused on. Once you find that minimum return that you need, then you can change your goals if you want. I mean, if you want to strive for something higher and take on a little bit more volatility than is necessary, that's completely up to you, and it's completely subjective. But what you really need to know is, what's the minimum rate of return I need to be successful? And once you're achieving that, the rest is all gravy.
Yeah, it kind of reduces the market noise. You don't have to worry about it so much as long as you're on track hitting that number.
Yeah, exactly. And if you don't want to, you don't have to take on more risk than you have to.
Exactly. Next question is about the market dropping. So if the markets continue to drop or pull off, how much of my portfolio will I see drop off?
Yeah, I mean, this is again, it depends on the style of portfolio you have. I mean, some of our portfolios are designed to drop even under the worst case scenarios, under less than 10%. Some might be with a little bit more volatility. It depends on you. And what is really important in this, though, is to know that if, let's say, the market does drop down by 20%, what could you expect to drop by? Because that's a pretty regular number in the markets. I mean, it could drop by 20%. In fact, it does it almost historically every 3 years. Mm-hmm. So if it drops by 20%, you need to know what that means for you. In a balanced portfolio, we're trying to limit that to down 10% or less. In a growth portfolio, you have to expect that you're going to drop down with the market, or at least close to it. And so what's important in all of this is to understand where your portfolio is positioned and what you can expect under those situations. And if you don't know that, then you should be asking your advisor about that, so you can make sure you can sleep at night still.
The third question, will I be on track? Will I still be on track under the worst case scenarios? So think 2008.
Mm-hmm. This is where having a good, solid financial plan in place is extremely important, because again, 2008 may have been kind of a unique experience because of the way it happened, but the fact of the matter is we're going to see more market meltdowns in our lifetimes here. So you need to have a good, solid plan in place, which you know what you need to achieve to accomplish your goal, and you need to know how that works out with the different market fluctuations. We will see market fluctuations. Mm-hmm. That is a guarantee. And so you need to know how your portfolio will react and what that means for your longer-term goals. If you need to average a rate of return of 4.5% per year to achieve those goals, then what does a negative 10 do to that in a difficult market? And how does your portfolio recover from that? So again, having a strong, solid financial plan which projects out is crucial to understanding that, and crucial to putting you at ease about even a situation like a 2008 financial crisis.
Last question. If I'm drawing an income from my portfolio, is that income protected? And if we experience a market meltdown, am I going to have to be selling assets at prices below what I paid for them?
Yeah, this is a really good question, especially because most of our clients will remember how they felt through 2008. And a lot of people listening will know what that was all about, right? And so what is really critical with your portfolio and where you're drawing your income from is that you can never draw money out of an asset that's gone down in value. That's the portfolio killer, and that's why you need to have strategies. We use one in particular called the cash wedge strategy, which essentially, long story short on that is we can ensure that our clients will never draw out money from an asset that's gone down in value, as we set up 3 years worth of income that's in guaranteed, if not very well protected investments that you will be positive in value on. So if you want more information on that, I'd be happy to go through it in person. It's a little bit complicated to do on the video, but I'd be happy to share that with you in person. But the long story short is you can never draw money out of an asset that's gone down in value, and that's how we make sure your income is protected.
Great. Well, with that, if anyone would like these questions in physical form, we've sent it out before in one of our weekly email newsletters, but we'd be happy to send it out to you individually if you didn't quite catch it.
And like I said, I encourage you to ask your advisors these questions, and for our clients, if you don't know the answers to these questions, I encourage you to ask us, because we hold ourselves to a very high standard, and we expect that anybody else should hold their advisors to that same standard. So
great.
So we'll close it off. Any other questions you have, please visit our website, www.whitehewsonwealth.com. Feel free to give us a call, send us an email anytime, and look forward to the next episode. So, ready,
aim,
fire.